Good morning, everyone. Happy October. I'm Pauline Lam, your 2020 Co-Chair Education Committee. Welcome you joined today's class, how to use DTS for 1031 exchange. This meeting will be recorded, and should you have any questions, please enter it into the chat box. Speaker will answer you during the Q&A section. We are so happy today, our 2020 President, Mindy Ye, to introduce our speaker right now. Mindy, the floor is yours.
Thank you, Pauline. Good afternoon, everyone. And thank you for joining us this afternoon on our special complement webinar, 1031 Exchange and Using Delaware Statutory Trust, called DST for Exchange Planning. Our special speaker, Warren Thomas, founder of JRW Investment and a managing partner of Telos Capital and Exchange Right. Prior to forming JRW Investments in 2003, Warren developed an extensive tax practice including estate planning, financial planning, and real estate advisory services. Warren has over 35 years of experience as a CPA and has been an active commercial real estate investor for the past 15 years. He graduated in 1978 from Biola University with a BS in Business Administration, specializing in accounting. He also earned a master's degree in taxation from Golden Gate University in 1993. Additionally, Mr. Thomas maintains a variety of securities licensed through Lighthouse Capital Group, LLC, member of FINRA, SIPC. Warren also maintains a California real estate license. I would also like to thank Mr. Keller for introducing me to Mr. Thomas. With that, please give a warm welcome to Mr. Thomas. Mr. Thomas, take it away. Thank you.
Oh, thank you very much. I appreciate that, Mindy. And thank you all for joining us today. There is so much that we can cover today as we talk about 1031 exchanges and the use of Delaware Statutory trusts for possible exchange planning. So I'm going to kind of jump into a presentation. We're going to learn a little bit about 1031 exchanges, and then we'll get into what a Delaware Statutory Trust, what the history of them are and how they work. Anytime during this presentation, you're welcome to type your questions into the chat box. I will cover a lot of ground here today, and so your questions may be answered as we're going through, but please use the chat box. Any question is a fair question, or else it won't get read at the end. So we're looking forward to this time with you. So a little bit about Exchange Right. Exchange Right was a company that I founded with two partners in 2012. And I am the gentleman over to the right-hand side of your screen. I started in CPA practice actually in 1978 when I graduated from Biola University. And I went to work as an auditor. By the mid-'80s, I had founded a 3-office CPA firm. My primary office was Pasadena, but we also had offices in Riverside and in Costa Mesa. So my background came out of a heavy tax background. I obtained my master's in taxation and continued in that business until 2007. In the 90s, we introduced financial planning to our CPA practice. And by the late 90s and early 2000s, we had quite an extensive real estate practice. So that's a little bit about me. I have two partners in Exchange Right, Joshua Ungerecht and David Fisher. I recruited Joshua as a fresh student at 21, 22 years old about 16 years ago. And then David Fisher is also out of the CPA side of things and an investment banker. So a little bit about the companies that we run, and this is important as you understand 1031 exchanges. I founded Exchange Right in 2012, and Exchange Right was one of the leaders and is one of the leaders in providing Delaware statutory trusts which you popularly will hear the name DST. By 2015, so 3 years after founding, we had become the third largest DST provider in the United States. The map that you see on your screen, the brownish orange squares or colored states, those are the states that we currently have properties in. We are a vertically integrated real estate company. We buy primarily now, it's net lease investment grade credit tenants, which we'll get into that a little bit more later, but we package them into portfolios that an investor can come into to satisfy their 1031 exchange. And then we manage the properties on behalf of the investors, send out monthly distribution checks, and eventually we'll work on the sale of the property. So currently we're buying about $100 million of property every 30 to 45 days across the country. And the properties are net lease, big names that you typically would know, like Walgreens, Walmart, CVS, Dollar General, that sort of thing. We do have multiple platforms, which are both 1031 platforms and REIT platforms and value add real estate too. We've done quite a few net lease programs, anything from development of RV parks to building of movie studios, building senior housing, building student housing, remodeling shopping centers. So we get into a lot of different things, but it's really just, we started from scratch 2012 and have really been blessed in our growth. We now have about 2.9 billion under management and growing, and we have 725 properties in 38 states. From an investor perspective, all of our previous programs are meeting or exceeding initial projections. And so, it really helps when you can deliver according to what you expected. So, and so clients that we have might have come into a 1031 program 5 years ago, 8 years ago, and they're doing quite well in those programs. We're in an interesting environment now, today with COVID. The type of properties that we have been buying have done extremely well in COVID. We've got, again, 725 properties, and we haven't had any that have ever had a missed rent payment or have had a forbearance agreement or had rent renegotiated. And that's because basically the properties we have been considered essential for the most part under the new definitions. That's a little bit about us. This is, we have properties that are all of, if you see the pie chart, you see a number of names that you know. We build 1031 programs that have these properties as their core. And for what you're interested in as a broker or a realtor is, you're there to service your client and to handle their sale efficiently and to provide them with appropriate options. And DSTs are appropriate for some investors, and they're not at all appropriate for other investors. So we're going to hit today what makes a program appropriate or inappropriate for you to consider perhaps referring out part of that 1031 exchange that your clients are looking to do. If you look at the DSTs that are being marketed across the country, they are marketed to accredited investors only. An accredited investor would be an investor that has $1 million net worth without regard to their personal residence. So an accredited investor is an investor that, according to the securities regulatory guidelines, should be coming into these types of properties, given that their whole financial picture where it would be suitable for that. But if you have an investor that has their primary residence and 1 or 2 rental properties, and they don't have any other significant assets, where they wouldn't reach $1 million if it weren't for their residence, then they're not going to qualify to be engaged in a DST. So you can kind of put that as a bucket, in that DSTs are for those investors that have $1 million net worth or higher without regard to their personal residence. Okay, really important, because you don't want to start referring people, telling them about a DST when they're just not going to qualify to even get in one. There is an income requirement that you could meet instead of the net worth requirement. And so you might have someone that has a high income, but not very many assets, and they want to exchange their rental property. They might make the accreditation requirement because of their income. Okay, so all of the programs that are really worth their salt are going to be accredited only programs, and they're going to be sold through a what we call a private placement memorandum, or a PPM is a common phrase for that. Okay, every piece of real estate has risks. There's a whole bunch of them on this slide, but you know that if you're in real estate, you know, lack of liquidity, and there's not always a market for real estate, and debt changes, and earthquakes happen, and fires happen. All of these things, you know, impact the value of real estate. In addition to it being, in many cases, a type of real estate that your investors may or may not have had any experience with, depending on how you're going to use a 1031 exchange in their planning. Okay, so there's lots of issues you need to be aware of. Every piece of real estate is going to have risk, but there's also going to be benefits associated with each of the different types of programs that you might use. Okay, so now I want to kind of jump. I'm going to go right into more of a tax law and give you an overview of how the taxes work in doing a 1031 exchange. I want to look at the process of a 1031 exchange, and this would be an area where you're probably going to trigger a lot of questions that we will get to, okay? So let's talk about a 1031 exchange. First of all, the IRS stated that no gain or loss will be recognized on the exchange of property held for productive use in a trade or business, or if it's held for investment, if you exchange that property solely for property of like kind, which is held for productive use in a trade or business or for investment. Now, this code section 1031, that is the code section, okay? Code section 1031 has not been in the law forever. It was originally not called code section 1031, but 100 years ago, we saw the first exchanges. So right around 1920, we had the first exchanges, and typically they would be farmland or farm animals for farm animals. It's very interesting. Farmland for farmland, farmland for farm animals. And the idea was I could exchange my acreage for your acreage, and I might want to grow, you know, some crop that required dry farming, and you might have had irrigated farming, and I didn't want to do this, so I want to swap the land. I don't want to pay tax on it. So originally, when Code Section 1031 was even pre-Code Section 1031, it was used primarily to swap farmland for farmland. And IRS said, hey, you don't have to pay tax. If your land has gone up in value, as long as you swap it for something of a like kind, we're not going to have you pay tax on it. When it came to farm animals, you could swap your bull for the neighbor's bull, okay? But you couldn't swap your cow for the neighbor's bull, okay? They were not considered like kind. So it's interesting how definitions of what is and what is not like kind really do matter. So we're going to cover that in a couple minutes. The IRS has made some changes in 2017 as to what qualifies for like kind, but basically, in general, it's going to be any real estate that is traded for any other piece of real estate is going to qualify. And on personal property, like that cow or like that bull, they knocked out all the personal property transactions about 3 years ago. So we no longer have to be concerned with whether you could exchange your car for another car tax-free or your boat for another boat. They knocked that out, and your animals for animals have been knocked out. So we're only dealing with real estate. So that makes it a little easier. Now, so why do people do this 1031 exchange? Well, it's all about the taxes that might be saved in the process. So if you, on the first illustration there where you see the blue building, it's gone up in value. So the selling price is more than the original purchase price. And if you just sell it and you buy the next building with it, the government's going to take their piece. And that could be state taxes, it could be depreciation recapture, it'll be federal taxes, and there may be nuances to those taxes. So I'm going to cover that in just a little bit. Over to the far right, you see the blue building is sold, but it's sold and it's exchanged in the process for another building. Now that new building might be the same value as what you just sold for, but you're not going to have to recognize a gain on the exchange because the IRS says it's going to be like into another piece of property. And as long as you buy equal or greater value, you're going to be fine and not have to pay taxes. So the reason that 1031s are so popular, it's always tax driven, is one of the primary motivations. We'll look at some other motivations in a few minutes as well. Okay, so what is the process? If you're going to do a 1031 exchange, what do you have to be aware of? Well, first, we talked about it being like kind. So is a apartment house like kind to a retail strip center? Well, the answer there is actually it is. So the like kind definitions are very broad, and there will be certain like kind property that just doesn't feel like it's like kind. But if it's real estate for real estate or real estate for other things that the code says are real estate, even if they don't feel like real estate, they're still going to qualify. Okay, second thing you have to do, the second bullet point there is the seller may not take constructive receipt. So what that means is if you sell your property and escrow sends you a wire for the proceeds from the sale of that property, and you put that wire into your bank account or you control it in any way, you have just constructively received the payment for that building. And the IRS says you can't constructively receive it. You actually have to have a intermediary, somebody in the middle that's going to get the cash and hold on to it while you go about finding the property that you want to buy to replace the one you just sold. Okay, so you can't take constructive receipt. If you find that you've got a client that wanted to do a 1031 and they didn't set up their qualified intermediary, also called a QI or an accommodator, they didn't set it up in advance and they took the cash, they cannot undo that. They can't unring that bell. They're going to end up having to pay that tax. So you want to be planning with your client ahead of time. When they start to say, hey, I want to do a 1031 exchange on my rental property, then you should say, okay, fine, let's go ahead and put that in your signed listing agreement. And then we're going to check the box when we get to the contract, when they go under contract, mark that box. And then you may have a referral for them that you're going to send them to a certain qualified intermediary that you've worked with before to actually take the receipt of that money. You also have to watch a time frame. From the day you sell the property, you have 45 days for your investor to identify what they're going to go into. What are they going to replace the rental property that they just sold? What are they going to replace it with? Well, they have to tell their qualified intermediary by day 45 of what they're going to go into. If they don't, then they cannot do a 1031 exchange. They can't wait until day 46, 48. And once they've made up their mind, and let's say that they tell the qualified intermediary on day 25, well, they can change their mind all the way up until day 45. But once they pass the 45th day, they can't change their mind. Now, many of you probably got involved in 1031s this year. And because of COVID, we had extensions on dates. And so we had transactions that were occurring roughly April through June got extended. And so these 45 days and 180-day deadlines all got moved around. But we're back to normal again, unless you're in a federally declared disaster area that might qualify for other fire-related extensions. Okay. The third thing we have to watch here on these on the process is that your investors have 180 days in total to actually close on what they want to buy. So if you actually, let's say you help them to sell their property today, then you count 180 days from now, and they would have had to not only identify within 45 days, but now they've got to close on those properties anytime up until day 180. And that 180 is not half a year, okay? It's 180 days that are counted, okay? It's not a half a year. And there are also some other problems with that too, or some things to watch out for, because if you're doing a transaction at the end of the year, your 180 days can actually be shortened to the due date of their tax return. So let's say that you have a client that is selling as an individual and you close their escrow on December 30th and their tax returns are due April 15th. If they don't file a tax return extension, then they've just had their 180 days shortened to April 15th. Okay, so you have to be a little bit careful when you're dealing with end of year transactions that you don't mislead or misguide your client. And of course, this shouldn't be your responsibility anyway. As a realtor, we know something about 1031 exchanges, but you're not going to play the role of their CPA. You shouldn't be playing that role. And so they can go back to their CPA and work with them to make sure that their deadlines are met. Okay. But so those are three really basic rules. So we'll go from there to, let's look at what property qualifies. I've already kind of hit on this a little bit, but you can exchange property for property. If you were to look at the top of the screen and you say, okay, let's say the one on the left is an apartment house and the one on the right is a store or something like that. You sell your apartment house, you can go into a store. Does an apartment house seem like kind to a store? No, it doesn't seem like it, but it is, because it's commercial real estate to commercial real estate. And it could also be going from a rental house, the second little illustration there. That sign, if you can't read that, that sign says for rent. So that could be a single family rental house in San Gabriel Valley that is being sold. And guess what? It can go to an office building. It can be put into a strip center. It can be put into an apartment house, a big apartment complex. They're all considered like kind, even though they're actually quite different, okay? But it's considered investment property for investment property, real estate for real estate. The next one's a little bit trickier, because that one says home sweet home. Well, on home sweet home, you cannot do an exchange of your personal residence into a rental property or into an office building or any other commercial piece of real estate and get a 1031 exchange out of it if it was truly your home sweet home. Okay, if it was rented out in part, let's say that you and your wife, or your client and his wife, lived in 50% of it and they leased out 50%, then the part that you lived in would not qualify, but the part that they rented out would qualify. But again, the general rule is home sweet home does not qualify for a 1031 exchange. What does it qualify for? You have a 121 exemption of $500,000 or $250,000 that it can qualify for under a different section of the code. Okay, so and the way that would work, again, let's say on this little house, this little blue house, it was bought for $200,000. They've held it for a few years and now it's worth $1 million. Okay, so they sell it and they net $1 million. So now how big is their gain? Well, the gain is the difference between what they bought it for, 200, and the $1 million. So it's 800,000 gain. But under code section 121, they get, if they're married, they get 500,000 of that 800 grand tax-free, okay? And they can not only get it on this house, but they could then go into future houses and requalify if they've lived in those future houses for long enough periods. So it's really kind of nice that we have that 500,000 available. But in reality, you know, you guys are selling houses out there that might have been bought for 400,000 or 200,000. But, you know, my house, I'm up here in Kinaloa Mesa area. And my house I bought as a foreclosure, actually, quite a few years ago for about 400K. And I got a neighbor selling the same model house for about $1.8 million is asking, and they think they'll get $1.9 million or $2 million. So if that were the case, suddenly these gains that we're seeing on residential property are so high that that 500,000 exemption just, it helps, but it doesn't solve their problem. So every once in a while, you'll see a client that will actually move out of their personal residence and they will rent out the house and turn it into a rental property so that they can do a 1031 exchange. Or they might move into part of their house and bring in renters so that they can still get the 500,000 exclusion and do the 1031 exchange with the other part of the property, okay? And of course, those of you that are working with investors that live in the front house and they rent out the 3 units in the back, that will always be a bifurcated sale where part of it qualifies for the 500,000 exclusion and part of it qualifies for 1031 exchange, okay? And you don't have to reinvest the part that was associated with their personal residence in order to get that 500,000 exclusion. I've just said a whole lot, and I know there's 1,000 situations out there, all of them a little bit different, but just to know, 1031 exchanges work for most property unless it's personal residence. But finally, the last little illustration on the bottom there, you see the fellow in his easy chair there. He's out enjoying the sun, and there's a palm tree outside of his house. Well, so that might be his vacation rental over on Maui. It might be his vacation rental up at Big Bear or up in Fraser Park. But what you'll see there is that it does not qualify for 1031 exchange. Vacation properties are considered to be personal, and so they don't qualify for either that $500,000 exclusion or to be treated as a 1031 exchange. How might you get around that? You might get around it by actually turning it into a Airbnb, you know, start renting it out and turn it into a bona fide rental property, which could then do a 1031 exchange. Okay, probably enough on those little cartoon illustrations. Let's go over to the left side and examples of qualified property. Believe it or not, all of those examples are qualified property compared to any other on the list. So you can have raw land and you can exchange it for rental property, condo, apartment, farmland, oil and gas interests. Who would have thought, right? But oil and gas interests qualify for 1031 exchanges. You can also exchange it for TIC interest. What's a TIC interest? Well, a TIC interest is a tenanted common interest in a property. So if I own 30% of a property and I've got my brother owning 20% and I've got, you know, my sister owning 50%, then they could sell their 30%, their 50%, the 20%, and they could exchange into either whole ownership or they could go into another property where they just own a piece of it as a TIC, okay? So TIC interests, you could sell a house and go into a TIC, and you can do that whether into these syndicated TICs that were popular 10 years ago, or you can do it with your neighbor or your friend, okay? Water, air, mineral rights, you'll see a bullet point for that. If you wanna own water rights, air rights, mineral rights, they qualify as 1031 exchanges when you sell your apartment property or when you sell any other rental property. The last one on the list on the right is the Delaware Statutory Trust that we're focusing on today. And a Delaware Statutory Trust, it is a group investment in that we might have 70 or 100 investors, so it feels a lot like almost a mutual fund of real estate, but it qualifies for 1031 exchanges as long as they are built properly by the group that brings it out. So all of those things you see on the list, you might take one more quick look at that, but they all qualify for 1031 exchanges, and you can mix and match them. Okay, so you do not have to go from a rental house to a rental house necessarily. Okay, so let's go to the qualified intermediary. So qualified intermediary, and I apologize for the typo there on qualified, but qualified intermediary is the person that, or the company that is holding the relinquished funds from your sale until you do the reinvestment, okay? And when you select a qualified intermediary, you want to be real careful on knowing that they have the expertise, that they're financially secure, that they're known or nationally known, and that they, not on the list, but you want to make sure they're keeping segregated accounts. They're not mixing your investor's money with somebody else of the investor's money. You want them to have segregated accounts, and you want to make sure they're bonded and insured. The qualified intermediaries are not actually licensed or regulated. So you need to be careful that you're working with a good group. Well, fortunately, a lot of qualified intermediaries are actually owned by the big national title companies. So if you're used to working with Fidelity Title, Chicago Title, etc., you're going to find that they actually own a qualified intermediary arm of their company, and that usually will mean that you're going to have a, you know, a bona fide group to work with that knows what they're doing. Saying that, there are a lot of really good local ones too. So what happens, you know, when you have the intermediary in the middle, you basically, you exchange, your money goes to the qualified intermediary, the deed goes to your buyer from you, and money changes hands and deeds change hands, but it's all happening with this intermediary organization that's handling it by agreement. So if you're going to do a 1031 exchange, qualified intermediaries can often set up the account and be ready to position the funds with as little as a couple days notice. I mean, you don't want to do that to them. I've seen where same day of closing, docs have been redrafted to bring in the qualified intermediary last minute, and they pulled it off, but it meant everybody had to be moving at the same speed at the same time to get that done. It's really, really dangerous to go that far. But at the end of the day, the qualified intermediary then transfers their money to the new property that you're buying, and they're out of the picture. And then you, as the new owner of that property, have the deed. And if you needed to add cash, you're adding the cash either through escrow or through the qualified intermediary. And now you own the property at the end of the process. So a couple things about, you know, who are these guys called qualified intermediaries? Well, you'll notice some of these names, you know, whether it's asset preservation or IPX, locally, downstream exchange, and Epic Deed, and there's a whole lot of them, and you guys have all of those that you've worked with. But again, as long as you're careful that they are secure, we have our share of clients that would want to go to the cheapest, the least expensive, and often they're going to some of the locals to get, you know, to save some money, whereas the nationals might be a little bit more expensive in some cases. So you have to have a QI, the first bullet point, to meet the Treasury regulations. So you cannot do it without having a QI. I've had, last year we had a couple investors that tried to have the money, you know, going from one account to another account, no QI. You got problems with doing that because there's, even in there, there's a step you need to take where you have a abbreviated QI in the middle. So we already said what qualifies a qualified intermediary. Really nothing. They don't have to have special licenses. They just have to be independent. The disqualified people are, you can't use your own attorney, your own accountant, your own real estate agent, your banker, your stockbroker. None of those folks qualify because you already have a relationship there, so they're not considered independent. Okay, so we'll get off the QIs here. Let's go to rules. Now, rules on identification. I mentioned earlier that you have to identify what you're going to buy within 45 days from the time that you sell your property. And so there are 3 basic rules that you could follow. Historically, most investors would use this first one called the 3 property rule. Under the 3 property rule, you sell your property and you can name up to 3 property addresses with your QI. So property address 1, you know, is 1 Main Street. Property number 2 is 2nd Orange Avenue or whatever, but you can name up to 3 addresses. And as long as you bought either 1, 2, or all 3 of those properties after your 45 days or even before your 45 days was up, you were fine. You qualified because you did a proper identification. Well, that works fine as long as your client's going from selling a property to buying 1, 2, or 3 properties. But a lot of times these days, we find that an investor wants to buy more than 2 or 3 properties, more than 3 properties, because they might be using a DST, or they might be buying, you know, a particular property, and then they want to also buy additional properties or DSTs that might have more than 3 properties in them. And so that means they've got to step into a 2nd rule or a 3rd rule. So the 2nd rule is called the 200% rule. And what that means is if you sell for $1 million, you can identify any number of property addresses up to $2 million of value, okay? So your clients just sold their rental house for $1 million and they want to go into something that's got more than 3 properties, so it might be a pooled investment. And so now they can identify property addresses up to $2 million. That's the 200% rule. It's based on the fair market value of what they sold before closing costs, okay? So often your client that sold for $1 million, they actually have what, $950 left after commissions and costs. So 200% is based on the $1 million, not based on the $950. So they could, again, identify up to $2 million worth of property. There's a 3rd rule there. It's called the 95% rule. And I've also referred to it as the telephone book rule. Under that rule, your clients could identify everything in San Gabriel Valley, right? They pull out the telephone book if they can ever find one, and they can identify every address. And IRS would say, okay, you can do that. You can identify everything. But they have to be able to close on 95% of what they identify, okay? So it's a unique situation where we see this 95% rule used, but we do see it used. So when you get into a 200% rule where they want to buy more than 200% of value, you might find that they want to buy, you know, 300, 400% of value, and suddenly you find yourself having to use the 95% rule. Now, this is all getting kind of technical. I'm sure you don't care until you've got a situation there, but just to know, we see a lot of the 200% rule used. We see a lot of the 3 property used, and we're seeing a growing amount of 95% rule used. Okay, so why does somebody do a 1031 exchange? Well, if it comes to a DST, it's often diversification driven. So you could sell the rental property, do a 1031 exchange, and you can go into a DST that might have 20 properties. My DSTs, typically I build them with 20 to 25 properties in each one. Why? Because my average investor is about 70 to 72 years old. They've made their money in real estate. I want to diversify them to help protect them, right? So a lot of times 1031 exchanges are done to diversify in order to protect, you know. So this is one way you could do it. You could sell that one rental property and you can buy any number of replacement properties as long as they fit within the rules that we just talked about. Also, you'll see just the opposite at times. Sometimes you'll see where your client owns a bunch of property that they've accumulated. And frankly, this is especially true with realtors that work with us. I get realtors that come to us for our DSTs that own 20, 25 properties that they've accumulated when they, beginning when they were in their 20s or 30s, and now they're in their 60s or 70s, and they're going, hey, it's time to sell. I love the market, but I want to go ahead and start selling a number of properties that I have, and I want to consolidate and not have as many properties to manage anymore. So we'll see sales where they're selling multiple properties or multiple parcels, and they do a 1031 exchange, and then they go into one program, whether it's one shopping center that you locate for them or one DST that has 20 properties, but they're trying to consolidate what they did own, make it easier on themselves, and then move into larger property. So that's also quite common, see it all the time. Moving markets. This is interesting, and you'll see that I kind of changed the markets here in that, okay, so we sell in California. Why are people thinking of selling in California? Well, here's another one. In my neighborhood, I had a neighbor, I was out getting my mail and he was driving home and he says, Warren, he said, I'm putting my house up for sale and I'm gonna sell it by before the election. And I wanna be moving by then. Okay, well, where are they moving to? They wanna move into states that have either more rural or lower tax rates, or other opportunities. Maybe they think it's a better place to live. So we're seeing a lot of people trying to take their gains off the table in California. We see certain degrees of concern and sometimes outright fear about rent control issues and the reassessment of the taxes that are under these current proposed measures that we're seeing on the ballot. And so people are looking at, I want to sell in California and I want to buy, we'll say in Idaho, where the tax rate is max of 6.8 or 6.9%. So I get it. Those are all motivations. They just want to move markets. Sometimes they want to move markets because they want to increase their cash flow too. And you can do that if you're selling in a California market where the average cap rate or return on equity is about 2 to 4%. And you move it to another state where the average cap rate is 6, it just means, okay, they've got more income for retirement by perhaps selling their California property. And they're coming to you because they want to sell, but they might not, be willing or have any inclination to reinvest in California again. There's also a lot of folks sell for estate planning purposes. You can do a 1031 exchange where you sell your property and then they buy, 3 or 4 or 2 properties that they can then give those specific properties to their children and make their estate planning a little bit easier. When it comes to a DST, DST is divisible as well. So you could sell their rental property, do the 1031 exchange, have them buy a DST, and then the DST it's like having shares of stock. They're actually called beneficial interests. And so maybe they're acquiring, we'll call it, make it easy, 100 beneficial interests when they sell their property. And they've got 2 kids, 3 kids, 4 kids. They could simply tell the DST company, hey, we want this many of those units to go to this kid, this many to this one, this many to this one. Or you could also work with their trust and their trustee and very easily distribute the DST interests into irrevocable or revocable trusts, or distribute them out when the trusts are finally dispersed, whether to charity or to family. So it's very common to be seeing 1031 exchanges in general done in order to accomplish better estate planning for the children or the grandchildren. Okay, so balancing the exchange. Simple rule. If you want to have a completely tax-free exchange, you need to pay attention that all the cash invested, if you read with me over to the left of your screen, the cash invested in the replacement property must be equal to or greater than the cash received from the sale of the relinquished property. What does that mean? It means whatever cash you're getting out of the property you just sold, you need to reinvest it. Any of it that you put in your pocket and spend, that money will be taxed, okay? It's not to say that it's not appropriate sometimes to pull cash out of a transaction. Just be aware that if you want to avoid taxation, or what we call taxable boot, you want to make sure you reinvest all the cash, okay, that you're not putting it in your pocket. Many investors that are selling their $1 million property, and that's a significant asset, you know, they might have very little cash or very little mutual funds and other liquid assets. It might be quite appropriate for them to pull 100 grand or 200 or 300 grand out and pay the tax on it. That will not blow up the whole exchange. It will mean, though, that they're going to have to pay tax on that portion. And now to the right-hand side of your screen, let's read that. You'll see the debt placed on or assumed on the property must be equal or greater than the amount received from the relinquished property. So that means if you had debt on your rental property when you sold it, you need to have equal or greater debt on what you're buying. Because if you got debt relief in the sale, let's say I owed 500 grand on my rental property, and I find a property I want to buy, but it costs less, and so I'm not going to need as big a mortgage. If that's your decision, that's fine, but by buying less value on a property, you're going to pay tax on the difference. And by having less debt, you're going to pay tax, and the IRS is going to call it debt forgiveness, okay? So the general rule is you need to reinvest all your cash in an exchange, and you need to buy equal or greater value and have equal or greater debt on what you're buying. If you don't like debt, you don't want to have any debt, then you can always add cash to the transaction to cover the debt that just got paid off, okay? So that's balancing the exchange for those that don't want to have a taxable piece of an exchange. If you have clients that need to pull cash out and they're prepared to pay some taxes, that's fine. They can do that. It won't blow up the exchange. Okay, now DSTs. So this topic, we're talking about DSTs today. So what is a DST? It's a Delaware Statutory Trust. It was originally came into IRS revenue ruling back in 2004. So you see there it says Revenue Ruling 2004-86. That is the year that the rules were set forth by the IRS as to what qualifies as a group investment under the term a DST. What are the rules? What qualifies? What doesn't qualify? So these things have been around now for about 16 years, and they're no longer new. It's no longer something that you have to guess at. The rules are really clear. Some things that the Delaware Statutory Trust is and isn't, it's not a business entity, it's a trust. So anybody that invests into a DST, the trustee is there, the company that is managing those assets typically is the trustee, and we are managing those assets in trust for your investors. And again, it might be that we have 100 investors just like your investor. We might have an investor that's put 100 grand of their 1031 equity with us, and they might be, there might be another investor that put 10 million of their equity from their 1031 exchange with us. And we might have 70 or 100 investors in one DST, all of which we're managing, and we're a fiduciary looking out for that investment and those properties on behalf of the trust, okay? So it's a trust. It's also, bullet point number 2, it says it's a pass-through entity. It's not recognized for tax purposes by IRS as being a corporation or a partnership. And what does that mean? I like to say, like, if you have a living trust where it's you and your spouse, it's a living trust, you don't file a tax return on your living trust. What you do is if you're earning interest in it, or you've got rental properties that are owned by your living trust, you file all of that tax information right on your personal tax return. Okay, so a DST is like that. If a client goes into a DST, they're going to file a rental schedule, and they're not going to be filing, they're not going to get a K1. They're going to get a statement that goes on to their rental schedule. They're going to get it typically in January, so they got plenty of time to file their tax return. Okay, the trustee, bullet point 3, has predefined investment objectives. They have to pay attention to what they originally said they were going to do. They can't change that. They're locked in. If they said they're going to hold properties for a certain period of time, they have to do it. Okay, it's going to be restrictive so that you don't get these real estate companies that are getting fancy with the money. You know, they're very tightly controlled by the investment objectives. And then a taxpayer may exchange real property for an interest in a DST without incurring a 1031. And they can come back out the other side when that DST sells the properties that are in it. They can do another 1031 and go right back to owning a single rental property or commercial property. And they're not locked in forever. It all just depends upon what does the DST, what's their business plan? How long will they hold the assets before they sell? But once they sell, that investor can then go and do another 1031 anywhere they want. They can own it, a property by themselves again, whatever they like to do, okay? In our case, our programs, we know very clearly our exits, really important for us, that we are very clear with investors as to the holding period and what we expect. Okay, I want to give you just a quick picture. DST companies have a variety of DSTs that you could buy, okay? Exchange Right, which is my company, this is one DST that we did some time ago. It's a closed program. It's no longer available, but I've done now 40 DSTs that all are similar in many ways in terms of the model, the way I use debt, the way I buy properties, what properties I'm going to buy, how long the average leases are in the properties. Okay, so this is a program that was offered some time ago. It's not available. You can't get into it. I'm not going to show you a live program today, but I'm building these constantly. So, and this is one example of what you can find in the DST market. So in this case, you can see the top tenants. I've got Hy-Vee Grocery, Tractor Supply, Walgreens, Giant Eagle Grocery, Dollar General, CVS, Hobby Lobby, BioLife Plasma, Advance Auto Parts. Those are tenants that we bought the building, we put the building in to the DST, and the average lease length in this particular DST, the day that we put it together, was 13.9 years. So I have long-term leases with all of these tenants, and the tenants cannot get out of paying, whether COVID, whether fire, earthquake, doesn't matter. Their corporations are obligated to make the payment. The top line here, this DST had 62 million of equity that was available for investors that were doing 1031 exchanges. And we used 73 million of non-recourse debt. That means the investors didn't have to provide their tax returns. They didn't have to have credit checks. I had already gotten the debt. I had already signed my name to it. It's non-recourse to them. And that meant then the whole package, 62 million plus the 73.8, came out to $136 million package that investors came into. The cash flow initially on their equity started at 7.6 or 6.76%. They had a loan, which was about 54%, and the average lease term was 13.9 years. The minimum purchase was $100,000. That's why I say sometimes we get 100,000, sometimes we get 10 million. Doesn't really matter to us. We're managing the assets the same. And this one had 25 single tenant properties in it, covering 25 markets. The number of actual tenants would have been 9, and that would have been because I would have had multiple Walgreens, multiple dollar stores, multiple Tractor Supplies, etc. in here, totaling a total of 25 properties. And then we would have been in 10 states, the bottom right-hand area there says 10 states. You do have to watch when you're talking to your investors about using DSTs. If you have multiple property DSTs like we create, then you could have multiple state filings and your investors could get surprised, and you don't want your investors surprised. So that's something that you'd want to understand, that your investors might actually have to file. If they're going, they're going to buy property that's in Louisiana or Ohio, they can expect to have some Ohio or Louisiana filings, unless it's a very small amount of money that they're investing, and then it's, it might be immaterial to that given state. But this is one example of a DST. My company, we've also, I've built DSTs that have had just multifamily, where they're large apartment projects, where I'll put 2 or 3 apartment communities into one DST and sell one large apartment portfolio. We are currently, as a company, ExchangeRight is the second largest DST provider now in the industry. I mentioned we started in 2012. By 2015, we were number 3. Now we're number 2. And there are a number of other companies that are in the market that are promoting, apartment-only DSTs, or self-storage only DSTs, or medical office DSTs. So you want to be careful with, with your referrals. I own a company called JRW Investments, which was introduced at the beginning of the presentation. And we work directly with investors to not only help them get into the ExchangeRight DST, but also to get into these other companies that are offering other DSTs. And like with everything, due diligence is absolutely critical, because there's a lot of property types out there right now that, because of COVID, it's really iffy, until rent subsidies, until we know the future of rent subsidies, until we know evictions and all of this, there's a lot of property types that are just too risky to get into. The net lease arena, which I'm illustrating here, is a different animal. Those 100% rent collections all through COVID, et cetera, they are more being seen as a flight to quality. So there's a huge demand for those right now. But if you, we can talk to you about all sorts of different offering types and the companies that are bringing those out. So with what we do, we work with single tenant. We do long-term leases, broadly diversified in each program. I love to use moderate leverage, because we already went over how, if you're using a DST and your investor sold a property that had leverage, then you need, if they're going to use a DST or they're going to buy on their own, they need to have leverage on what they're buying. And so in my case, I believe in using only moderate leverage. And what that means to me is I'm going to be somewhere between 46 and 54% on a loaded basis as to what the percentage of leverage I'm going to use. And I want to have very high debt service coverage ratios. Okay, that's the 4th bullet point there, the second one up from the bottom, or 4th down. It's a high debt coverage ratio means I want to have far more than enough income coming off of these triple net and double net leases that I'm going to need to pay the mortgage. And I typically want to be at 2.3 to 1, all the way up to about 2.8 to 1. So I could have 60, 70% of my tenants, if they did go bankrupt, I still wouldn't lose a property to the bank. Okay, so that's going to be important with any DST, that you look at what they're, what they're trying to do. And then our DSTs, they've all started at 6 and above on cash flow. Typically, I'm at 6.3, 6.2. You just saw one at 6.7. That's typical what we will see these days. And that's important too, because your client that you're selling their rental and they're netting $1 million, they probably, after expenses, they're getting $1 million out of their property, but they were probably netting somewhere between 20 grand and 40 grand of net cash flow every year off of that 4-unit property. Now you go to this type of a DST, and if they were netting 2 to 4%, now they're starting at a 6.5%. So it might significantly increase, or even double or more on their initial cash flow. So it becomes very attractive for them to at least look at this. So what are some advantages and disadvantages if you do suggest a DST? Let's go to the advantages first. Well, they're going to have property choices and diversification, which they're not going to have in a single rental property. The investor cash flow yields, depending on if you're going to go to multifamily or self-storage, you might be in the 5s on the cash flow, 5% on their equity. If you're working with an exchange rate program, you're going to be in the 6s on equity. So it's got a cash flow advantage in almost every case for your investor. The financing, the rate, the terms that's already known before they actually come into any program. If I'm getting a loan at 3.5%, they know it's locked in the next 10 years. I've already underwritten it, already approved. We don't put anybody into a program unless we own all the properties and the debt is all in place so that there aren't any surprises on what they're going to buy. It's not an open-ended program. So the financing is good. They don't have to submit tax returns or pre-qualify. Structurally, it's pretty simple. They do the same tax filings that they had done previously. They're going to file on a Schedule E, a rental schedule. If it's owned by a partnership, their partnership, meaning if they own their interest in their own partnership, then we're going to just report the rental income to their partnership, and their partnership's going to report it like they always have on a rental schedule of their partnership. So there's no extra tax filings to do from that standpoint. You just have to watch the state tax filings, because depending on how much they put in, they might be triggering some state tax filings other than California. It's also passive ownership. That can be an advantage for many investors. When our typical investor comes to us actually as a retiree or a pre-retiree, and they're often looking to get out of some of the responsibility that they've had in the past, and so it's passive. And then finally, depreciation, it always passes through to the investor. We don't have to worry about, we don't take their depreciation. They get to carry over their old basis into the new property. And by doing that, they continue to get tax breaks. For those that actually come in with all cash, we can create new depreciation for them. So somebody that didn't have debt on their old property and they got their $1 million out of the old property, they can come into one of a portfolio that's a DST, and they can create new tax depreciation because we utilize moderate debt on our property, which means they're buying more property because of that debt allocation. Okay, other side of the screen, what are our DST challenges? And these are some of the top 4, okay? Illiquidity, okay? These are illiquid. Until the trust sells the assets, they're going to be illiquid, meaning there's not really a secondary market. Yes, if the owner, if your investor finds a buyer, no problem, we can, have the new buyer buy them out. That's fine. But in general, the DSTs are going to be held for somewhere. Ours are typically 4 to 6 years at a time. And some of them are set up to do 10 years or 15 years. So they're not highly liquid, okay? Second, control. If you have folks that love being in control, they're not in control once they're in a DST. They're passing that responsibility over to the DST company, and the DST company is working with your investor along with 3,000 or 4,000 other investors, and the control of managing the assets, sending out quarterly reports, sending out the monthly checks, collecting the rent is all being done by the DST company. Refinancing is a challenge for a DST. DSTs are not allowed to refinance. There was actually a request of Treasury when COVID came out, where they asked Treasury for permission to allow refinancing. And currently, they are being allowed during a very short window where the Treasury Department actually allowed it. But in general and under normal situations, you cannot refinance a DST. So you typically don't use DSTs if you've got a development project where you want to put cash in now, develop it, and then refinance out. That just doesn't work in a DST setting. And then second, the costs of doing a DST. The costs are there. These are typically sold through the broker dealer and investment advisor community. So they make a commission. Our company makes about a 1.5% acquisition fee. And so we're making a little bit of money on it up front. And then the legal costs, the escrow costs, the appraisal costs, all of that are built in. So there are costs in doing a DST, and we can't get around it. We can control those costs, but when I look at a DST investor, I always look at a DST investor coming in. It's going to take 4 or 5 or 6 years to get them to a place where they can start to see over and above their cash flow and see some, some profits developing. So DSTs have costs, and they always will. Okay, what clients would you want to consider using a DST? Well, it's typically going to be a 1031 exchange investor. It's going to be an investor perhaps that is seeking more cash flow, and investors that are seeking to transition from active management to passive management. And believe me, there are tens of thousands of those folks out there that want to do that. And often it'll be the investor that's seeking to diversify. I gave you an example. One of the realtors I'm working with, she had, I think, 21 or 22 properties. And for the last year, every month I get another 1 or 2 properties that she's selling, because she's now in her early 70s, and she just said, hey, I want to become passive in my ownership. So she's becoming passive, and she's diversifying where she's now holding assets that are not just residential rental properties. Okay, and then we've already said accredited investors only. So there's more to it from a tax standpoint. There are maximum capital gain tax rates of 20%. The net investment income tax is 3.8%. Depreciation recapture can create a 25% taxation rate. State taxes, California's just proposed, if we went back to 2012, California was at a max rate of 9.3. Then it went to 13.3 if you were subject to the millionaire's tax. And now they're proposing 16.3. So just crazy. And every time these taxes are going up, you're seeing more motivation for 1031s to be done. Okay, and this is what it looked like in 2012. We had a 15% max tax for federal, 9.3 max tax for California. So it was 24.3. By 2020, it became a 20% max tax for capital gains. State tax is 13.3, but proposed to go to 16.3. Net investment income tax, also called the Obama tax, was 3.8, and total tax 37.1. So what we actually have had happen is we've had a 50% increase, over 50% increase in tax so far in California. So those are your motivations. We can create new tax deductions for them using DSTs, in DSTs that have an element of debt. And that new depreciation is worth real money. We can get into that. Happy to talk to you separately on clients. And that's basically, I think that's as far as I'm going to take it, because I'm using up my hour, and we'll probably have some other questions. So Pauline, if I can pass it back to you, and Mindy, any questions that you'd like me to handle? Thank you.
Great. It's very fantastic and so detailed presentation. Let's learn about what is a DTS, and then how to use a Delaware Statutory Trust for the 1031 exchange. And we have a few questions here. First question is from Teresa Huang. Can my clients doing the 1031 exchange a rental single residential house into a land purchase?
Yes. The short answer is yes. Those are both considered like kind to like kind, so they can do that.
And any key points or what kind of detail we need to be careful when we do this? Not like a house to house, is a house to land. Anything we need to pay attention for that? You do need to be careful that there's an investment purpose to the purchase of land. If they're going from a rental property to a piece of land, but the land is something they're going to now build their new home on,
it won't be considered an investment property, even though it's real estate. So you need to watch that. You also have to watch that if they're going from a piece of property and they're buying land that well, you already know vacation property is not going to qualify. And if they're in the business of selling off the land, so let's say they buy some acreage, but really what they want to do is subdivide it and flip it, then they have to be careful because IRS might consider that to be a holding of inventory where they have put themselves in the business of being a land broker or a land flipper, if you will. And then that would not qualify. But any land that they plan to build units on, it would qualify, or just hold for investment for the next 5 years, that's going to qualify.
Got it, got it. Next question is from Mindy. Mindy, would you like to unmute and ask a question by yourself?
Sure. Thank you, Pauline. Thank you, Mr. Thomas.
Yes.
Please address the growing concerns. I know that you mentioned that earlier about, you know, the tenant issue that we're facing in California, about the growing concerns with tenants either for residential or commercial during COVID-19 not paying rent affects the income of the building in respects to the DST exchange.
Yes. Is your question, what are we seeing in that?
Yes.
Yeah. You know, so far, I don't think we've seen a lot of distress. Well, a lot of concern, but I'm seeing I think I'm seeing the beginning of a movement towards sale by rental property owners because of that concern. But it hasn't really happened in mass yet. So as we see this presidential election, as we see any impact on 1031, which I do think that's a different question, but I think we're going to see an impact on 1031 with the election if the Senate and the White House changes, right? Because we've already been told under the Biden proposal that they want to limit 1031 exchanges to those with 400 grand of income. So it's going to that would knock out the bigger exchanges, which pretty much knocks out the whole market. But in California, I think it's a growing concern, but I think thus far there's been a lot of money still changing hands from tenants to landlords, and it hasn't become as big a problem yet as it might. So it's kind of wait and see. I've seen transactions that have been sped up, but not an overabundance of them.
Thank you. I also have one more question. So can you please elaborate on why for investors who are thinking about DST versus take tenants in common investments? Thank you.
Yeah, a couple of the differences between tenant in common and a DST. The traditional tenant in commons could have up to 35 investors, and the DSTs, the bank might limit them to 100 or 200, but the IRS doesn't put a limit on the number of investors in a DST until you get to 499, okay? So what does that mean? Well, it means that we can buy 100 million, 150 million of property and put it into one DST and get a lot of diversification and take a lot of investors that are very small investors. Under a TIC situation, because they can only take 35 investors, they're probably going to be limiting what they purchase to something that's $20 million, $30 million, maybe $40 million. And if they do that, you just don't get the same level of diversification in the program. So that's a disadvantage to a TIC. An advantage to a TIC is that you can refinance in a TIC. Another advantage is you have voting rights in a TIC. It's not completely passive, but you do have to agree with another 30 people or 35 people. So I don't know that voting rights is always helpful, but the TICs have The advantage, you could refinance. You might want to use them if you're going to do more of a development-oriented project. It's a little bit, you know, some people like control, think the vote is worth something to them.
Perfect. Okay, our next question is from Joanna Lin. Joanna is asking, the accredited investors value of 1 million exclude the mortgage. Is the net value same as equity?
The accreditation rules are based upon their net worth after debt. So it isn't based on gross value. And again, when we're talking accreditation, we're talking about just what is the qualification required in order to be a part of the program as an investor, right? It has nothing to do with whether they have debt or equity on what they've sold and how that works into their tax calculation. But these programs are set up for those that have $1 million net worth without regard to their personal residence, and it's a net worth, not a gross value. There is another rule which might apply to your questioner. If an investor has $5 million of gross asset, so let's just say that she has an investor that has an asset worth $5 million and it has $6 million of debt on it. It has zero net worth, right? It's actually underwater from a net worth standpoint. But because it's 5 million, we have a special rule for anyone that has 5 million of assets. Then if it's like in an entity like their LLC, if it's 5 million gross, even if it was loaded with debt, they still are considered accredited. Now, I'm not sure how the SEC gets away with that, but you might find that under that situation that it's being asked that they are accredited because of the 5 million limit.
Understand, got it. We believe a lot of skill inside, right?
Yes.
And next question is from Dan Lee. Dan Lee asking you, what about selling off the land and purchase investment property, such as a warehouse?
Yes, happens all the time. You know, we're dealing with land sales all over the United States where folks have their investment property. It might be farmland, might be just acreage that has now been developed, and they can sell off a portion at a time, buy commercial property, and it's going to qualify for 1031 exchange. No problem.
Got it, got it. And he has a second question. Is a DST investment module similar to REIT?
Great question. It can be. A REIT, the REIT is what you hear the word REIT, and it's a real estate investment trust. We actually, Exchange Right has a REIT, and I have a REIT that, you know, investors come into, and after they've been in, for instance, after they've been in a DST, if the DST sells its assets to the REIT, the investor in that DST, we give them 3 options. You can do a tax-free roll-up into the REIT of your equity, or you can take your cash out when the sale happens, or you can take your cash and go do another 1031 exchange. Your questioner is asking about, is a REIT the same as a DST or similar? Well, you can't do a 1031 directly from your rental property into a REIT. What you can do is do a step from your 1031 property to the DST and then to the REIT if the DST company has that already arranged, which Exchange Right, we built that into our program when we started the company. So your clients can go into a REIT, but they have to do the DST first because a REIT is not considered like-kind property. You can go from a DST to a REIT, but we use a code section that's called Code Section 721, and that qualifies for tax deferral.
Got it, got it. So very good tips. Thank you so much. And Mindy, do you still have other questions? No, right?
Yeah, then thank you so much.
Thank you so much. Perfect. We learned a lot today, and it's really powerful information and detailed information to us. We want to thank Mr. Warren Thomas again for your team and yourself to spend your treasure time to us. Thank you very much. And what a wonderful and informative presentation for how to use Delaware Statutory Trust DTS for the 1031 exchange. We love it. We love it. And this meeting is being recorded, and you want to review it again, you could get on our YouTube channel, West and Gabriel Valley Realtors, to review it, and then you can remember what Warren to give us so valuable information. And by the way, before the meeting adjourned, I want to remind you tomorrow, 11 o'clock, we have Annie Fan from Chicago Title. She wants to share do the deep dive on farming to get your next listing. I think this will be another wonderful class. And next week, we have a CAR Reimaging Real Estate Virtual Conference Expo, the first one, virtual expo. I think it's very exciting. Let's go together. It's all the classes is free. Okay, just register. So we'll see you tomorrow, 11 o'clock. And thank you again, Warren.
Thank you.
Thank you, everyone.
Mr. Warner.
Yes, Mindy,
sorry,
do you have
Mr.
anything?
Warner, would you like to share your information?
Oh, in terms of contact information?
Yes,
Yes, you are very welcome to.
Okay,
you can
thank you.
At W. Thomas, jrwinvestments.com. That's W. Thomas at jrwinvestments.com. One more time, and then I'll give you a telephone number. W. Thomas at jrwinvestments.com. Or my cell phone, which you're welcome to use, is area code 626-644-7033. That's area code 626-644-7033. And our primary offices are on Colorado Boulevard at Catalina, here in Pasadena.
Thank you so much. I typed it in the chat.